Hey, what's up everyone? My name is Ale. Welcome back to my world of stocks. Hope you're all doing well out there. In today's video, we're going to be talking about taxes. I know that thing that everybody hates, but it is currently tax season right now here in the United States. Filing deadline is just a little more than a month away. And so in today's video, I want to give you guys a very simple explanation for beginners on how stocks, dividends, and also cryptocurrencies are taxed. And yeah, cryptocurrencies, things are also taxed, so it's something you got to keep in mind. But I'm going to explain how all of that works and what you need to know in order to navigate your way through all of it. And I hope this video helps you. If you do find it useful, then please consider hitting that like button. Really helps the channel. Also, please subscribe if you haven't already. But with that said, let's go ahead and start with some simple foundational basics on how stocks are taxed, and then we'll start getting into the more complicated stuff as we make our way through it, because I think if we do it that way, it'll be a little easier to understand. You'll kind of see what I mean as we run through this. Okay, now the deadline to file taxes for most people here in the United States is going to be April 18th. If you live somewhere else or have special circumstances, then that date might be a little different for you, but a simple Google search will get you the exact date. Now, in terms of actually filing your taxes, when it comes to stocks, you're either going to make a profit or a loss. That's pretty obvious, right? And while losses are something that you should always be trying to avoid, it does at least help a little bit to know that whenever you buy a stock, the price goes down and you sell it for a loss, that amount of money that you lost on the investment will actually count against your profits in your favor to reduce your tax burden. And even if you don't have any profits, the losses can still be used to lower your ordinary income by up to $3,000 per year. Now, if you actually made a profit, meaning you bought the stock, the price went up, and then you sold it for a profit, then you're gonna have to pay taxes on that. And another way that you may owe taxes on stocks is through dividends, which is when you own a stock that pays you a dividend for basically owning it. And of course, all of this would be within the year that these transactions happen. So in this case, we're talking about filing taxes in 2022, which means it's going to include all of our transactions that we made during the 2021 year. And from here, your stock related transactions can be taxed in one of three different ways. These are what we refer to as short-term capital gains tax, long-term capital gains tax, and of course, dividends tax. So let's quickly break down each of those now. Starting with short-term capital gains tax, this is where you sold a stock for a profit within 1 year of purchasing it. So if you bought Tesla stock, for example, and it went up and you sold that stock in less than a year's time, then you're going to be taxed based on a short-term tax bracket, which is the same as your usual federal tax bracket. And to give you some examples, if you're single and you make less than, let's say, $40,000 of income for the year, then you'll get taxed around 10 to 12%. And before you ask, the answer is yes, you do need to include the profits from your stocks as income. So if your job paid you $30,000 and you also made a profit from stocks at around $10,000, then your total income is going to be $40,000. So again, you do need to include your stock profit as actual income when determining your tax bracket. And then to keep going with the examples here, if you make more than around $40,000, your tax rate will basically double to over 20%, as you can see here, and you can even reach the 30% range if you're making more than $165,000 for the year. However, if you hold on to those stocks for longer than a year, then you get taxed based on long-term capital gains, and that's where you can really start to see some large savings on those taxes. In fact, if you make less than $40,000 for the year, you literally won't get taxed anything at all. The tax rate for stocks is at 0%. And even if you go above 40K, you'll still get taxed only 15%. Whereas remember, with short-term gains, you would have to pay more than 20%. But in long-term gains, you don't even reach 20% until you make more than $445,000 for the year, which is pretty uncommon for most of us regular, like retail investors. So it really goes without saying that you want to get the long-term capital gains tax. That's going to be the lower tax and you have to hold on to a stock for more than a year to get that lower tax. And so you're generally going to want that in most situations. And then finally, we'll talk a little bit more about that in a second though. But finally, you have dividends. And these can get a little tricky because they're broken up between ordinary dividends and qualified dividends. But the easiest way to think of it is that ordinary dividends get taxed essentially the same as short-term capital gains, while qualified dividends get taxed like long-term gains. So obviously you want to collect qualified dividends whenever possible because that'll be the long-term tax rate. And the good news is that in most cases, all you really have to do is own the stock for at least a few months to get that benefit. The technical time frame is more than 60 days during the 121-day period that starts 60 days before the ex-dividend date, but that's way overly complicated. So just to keep it simple, you should just know that in most cases, you'll be fine if you own the stock for at least a few months before the dividend is paid, and you will most likely get that qualified dividends tax. There is some exceptions to this. For example, one of the exceptions is REITs and MLPs. Those have their own unique tax rules, so they're generally not considered qualified, but they can still have certain tax benefits too. So you just have to research each of those individually to know exactly what you own. But that kind of gives you a good idea of what the pros and cons are to short-term trading versus long-term investing. And it's one of the reasons why I generally stick to long-term investing myself whenever possible. The pros to short-term trading is that say you happen to buy a stock and it skyrockets by a huge amount within a short time frame, and you don't really think that that move is warranted, or you don't really believe in the company to that really high extent, then you might just want to sell the stock early, lock in those profits, and move on to other stocks that you believe in more. You will have to pay some higher taxes on it, but again, that might be worth it to you depending on your own specific situation. On the other hand, long-term investing is really beneficial for its safety, how much easier it is to make predictions, the lower pressure it comes with, the more calmness of just kind of being able to wait for a stock to recover or perform better over time. And of course, you will also get that huge benefit of lower taxes. The only con that I can really think of is that you're not going to be able to make those really quick short-term moves. So you may not be able to make that quick buck in a stock. You may have to hold on to a position a little bit longer than you otherwise maybe wanted to, depending on your situation. It's definitely something that requires a lot more patience, a lot more discipline, but for most people, I would say that it is generally the better strategy, and it is what I practice myself, and that is how you get taxed on it. What about filing though? What happens when you actually want to file your taxes there? What kind of information do you need? Where do you get that information from for all of your different stock trades? Let's just quickly cover that right now. We'll run through it really quick, and then we'll also talk about cryptocurrencies right after. Okay, now you probably use a stock trading platform like Robinhood or Fidelity or Charles Schwab, or even a combination of multiple ones like I do. I for example, use Robinhood, I use E-Trade, and I also use M1 Finance. Anyway, regardless of how many you use, each one of the ones that you do use will send you their own 1099 form. So for instance, here's a sample 1099 from Robinhood, and you can see that the number 4 area has all the dividend information, and areas number 6 through number 10 all have the short-term and long-term moves, including the cost basis, the profits, and the losses. And in most cases, this is all the information that you'll really need. If you have a tax professional handling your taxes, then you can just hand them these documents. They'll take care of everything for you. Or if you're doing your own taxes through some software like TurboTax or something like that, then it'll just ask you some simple questions. You'll just need to put in some simple information that you will be able to find in most cases in these 1099 documents. Okay, so now we know the basics of how stocks and dividends are taxed and how to properly manage them, but what about cryptocurrencies? Well, in some cases, I would say that cryptocurrencies, in some ways I should say, cryptocurrencies can be very simple, but in other ways, cryptocurrencies can be very frustrating when dealing with taxes. So I'm going to try to simplify it a bit for you guys. We'll keep it simple. We'll run through it really quick and then we'll wrap up the video. Okay, so the first basic thing that we should get out of the way is that cryptocurrencies are taxed almost exactly the same as stocks. If you buy and sell crypto within 1 year, then it's going to be treated the same as short-term capital gains. And if you hold on to it for more than a year, then that's going to be treated as long-term capital gains. And just like stocks, any losses that you experience in crypto can also be used to offset any gains or even lower your ordinary income by up to $3,000 as well. And in many cases, a crypto exchange that you use will actually send you a 1099 form that will collect and simplify all of this information for you. For example, Robinhood gives you a 1099 for all their crypto transactions, and the largest crypto exchange called Coinbase does the same for US customers as well. However, non-US customers don't receive any forms from Coinbase and will need to track everything on their own by looking at the transaction history feature on the platform. And this is where things start to get tricky with cryptos, because if you're not receiving a 1099 and you're frequently using cryptos, even to make regular purchases for goods and services, well, all of that activity is considered taxable, and it's your responsibility to keep track of the price of the crypto when you obtained it and when you used or sold it. So if you're using it very frequently, then you're probably going to have a headache keeping track of all of this information on your own. There are, however, softwares and apps that can help you keep track of crypto for tax purposes, like for example, Coin Tracker or Token Tax or Crypto Trader, but I haven't personally used any of those myself. I just use Robinhood to buy and sell a small amount of crypto, and it's pretty easy for me because they do send me a 1099. Now, eventually in 2023, all US crypto exchanges will be forced to track and provide 1099 forms for crypto, but just know that in the meantime, it may be a little tricky if yours doesn't. Anyway, those are the basics of stocks, dividends, and cryptocurrencies in relation to taxes. I try to keep it as simple as possible. Hopefully it was something that was beneficial to you guys. I hope that you enjoyed the video, and if you did, make sure you drop that like. If you have any questions, drop them down below. I'll try to respond to as many as I can, and we'll also have viewers, I'm sure very likely, responding to comments as well, so we can all kind of help each other. So make sure to leave any questions you have down there. But again, thank you for stopping by. I appreciate all the support. I hope you're all doing well, and I will catch you in the next video. Take care. Bye-bye.